Now let's talk about the Canadian stocks that I've been recently buying. I'll explain why these Canadian companies are solid investments for the long term, and they are on sale. The first one is TD Bank. Now I know the headlines about TD Bank and their latest earnings report was like scary, right? I mean, some of you are probably looking at this bank and like, hell no. But let's dig a little deeper and I'll share what I'm seeing in the financial report and the latest earnings. You can see that their revenue has been growing actually more than it was last year. Now, a bit of a concern was their net income took a little hit, but that's because guess what? We're in an environment where high interest payments are coming in. People are getting squeezed and looks like some of the loans haven't been repaid. So they're taking a bit of hit on the bottom line, but generally it's in the right direction. Their earnings took a little bit of hit because the profit margins dropped a bit, but they raised their dividends. What kind of bank would actually raise their dividends if they didn't think they were still heading in the right direction? Now the payout ratio looks good. Everything looks pretty solid. Some fun facts. TD Bank has been around since 1855. So it's been around for a very long time. TD Bank has been growing their dividends since 1998. Look at that chart. It's beautiful. The reason why I like TD Bank is because they have a very strong presence in Canada and they're trying to increase their presence in US so that they become one of the biggest banks in North America. Now, you know me, I love companies that grow, and make a lot of dough. And TD Bank fits in that naturally. Another thing I love about TD Bank is it announced share buyback. So what that means is that the company is planning to buy more shares so that there's less shares out in the market. So that means that each share is worth more to every investor. It's like the pie was divvied up in 4 slices. You get a bigger slice of the pie versus divvying it up into 8 slices. Now the next one is Royal Bank. We've got a lot of fear in the markets and the banks are on sale. With the latest earnings report taking, a bit of heat, it's caused these 2 banks to drop, okay? And I'm telling you, I don't think it's going to last long. It's going to be a little blip in the grand scheme of things. This is nothing like the financial crisis. We are not facing dire circumstances where real estate prices were falling, people were scared, people were losing their jobs left, right, and center. We don't have any of that right now. This is like a stark contrast even compared to the pandemic. So I'm telling you, these banks are well capitalized. And if you look at the latest earnings report, everything looks like it's in the right direction. Revenue, earnings, dividend growth, both of them increased their dividends. I don't know about you, but increasing their dividends is always a good sign that they're heading in the right direction. Here's a fun fact about Royal Bank. It's been in existence since 1864. And Royal Bank has been growing their dividends since 1989 from 13 cents. Now, if you want to see and hear my exact time when I buy these investments, and my rationale, check out Blossom's social investing app. It's free. Last but not least is Ritzia. Now, Ritzia is a fashion powerhouse that has existed for decades. It's like that designer handbag. It's always stylish, it's high quality, and it's always in demand. Now, you're probably wondering, why did Ritzia drop recently? If you look at its latest earnings, all the top line growth, its financial history is showing solid performance. But the thing that took a little hit was its profit margins because it made a very strategic decision to buy inventory ahead of the high season, which is typically winter with all the puffer jackets. And you can see with Google Trends, it tends to spike near the year end. So it made a strategic move with buying inventory now, which increases warehousing costs, which of course eats their profit margin. Of course, with inflation, rising costs, well, the profit margin dropped. Earnings is not as high as expected, but in the grand scheme of things, it's done a solid job with strategically increasing the number of stores. It has a payback period between 18 to 24 months for every store that they put in, which is like amazing. And it's still forecasted to grow double digits over the upcoming future. Now, if you looked at its PE ratio compared to its past, it looks pretty good right now. Is this a serious bargain? And just in case you don't know what the PE ratio is, it's the price of the stock you are paying relative to how much it's earning. It's like when you go to the grocery store and you see your favorite cherries go on sale. Typically, it could be $6 okay, and it drops down to $2, you got a bargain and the cherries are top quality. That's how I see Aritzia. It really depends on how you see its growth rate. With double-digit growth for the foreseeable future, within a great expansion plan that's focused in the United States and the acquisition of a men's product line, it all shows it's heading in the right direction. It has a resemblance of when Lululemon was just a baby and it was focused on the women's yoga line. But guess what now? A lot of men are wearing Lululemon because it's super comfy. Now, can this happen to Ritzia? For sure. Is it guaranteed? Obviously not. So this is just icing on the cake. So if you look at Aritzia, you got to ask yourself, can it continue on with double-digit growth? Do you think it is reasonable? Another thing I love about Ritzia is it announced share buybacks. So that means that each share is worth more to every investor. And stay tuned. I'm going to reveal how much dividends, passive income that I collect every single month. Bye.